Hey everyone, welcome to the 84th episode of Investing Kev. Week 2 of major earnings report has come out, and we'll take a look at 8 companies across different industries and sectors and how they performed and what they have to say about the future. We'll also take a look at some major news articles affecting the economy and the stock market. If you like this video, please give it a thumbs up, subscribe, and let me know in the comments how you're investing. Alright everyone, let's get started. The first 2 stocks we'll take a look at are SoFi and Airbnb. This is how the third quarter went for SoFi, ticker SOFI. In the third quarter, they had record adjusted net revenues of $419 million, which is a 51% increase year over year. In the third quarter, they added 424,000 new members. They are currently at 4.7 million total members, which is a 61% year over year increase. They believe their diversification of products being a one-stop shop has increased to more deposits, which is totaling 86% year over year. They are currently seeing an increase in direct deposit members because they offer a 2.5 APY rates on checking and 3% rates on savings. The median FICO score for customers is about 750, so these are really high credit customers. Currently, their student loan refinancing segment has been depressed, but they're getting more market share. As student loans start picking back up in January, I'm pretty sure SoFi is going to take more market share. The next stock is Airbnb, ticker ABNB. Their Q3 revenues were at $2.9 billion, which is a 29% year-over-year growth. They had a Q3 net income of $1.2 billion. Q3 was the biggest and most profitable quarter ever. They had nearly 100 million nights and experiences booked, a 25% year-over-year increase. They say that guest demand remains strong thanks to newfound flexibility where people can live and work. They also attribute to the recovery of urban and cross-border travel, which comprised majority of their business before the pandemic, and their guests are staying longer at Airbnb properties. The next stock is Etsy, ticker ETSY. Their Q3 consolidated gross merchandise sales were at $3 billion, which is a decrease of 3.3% year-over-year. This was impacted by macro headwinds including reopening, pressures on consumer discretionary spending, and geopolitical events. They had revenues of $594.5 million versus $565 million expected. Their Q3 revenues were boosted by transaction fee hikes, where the sellers were charged 6.5% compared to the previous 5%. Analysts are expecting a lackluster holiday shopping season, but Etsy believes their diversification allows them to weather the storms better than other e-tailers. The next stock is Roku, ticker ROKU. They had Q3 revenues of $761 million, which is a 12% year-over-year increase. They added 2.3 million active accounts in Q3, and their streaming hours are at 21.9 billion hours, which is an increase of 1.1 billion hours from last quarter. Their average revenue per user grew to $44.25, which is up 10% year-over-year. As we enter the holiday season, we expect the macro environment to further pressure consumer discretionary spending and degrade advertising budgets, especially in the TV scatter market. It is difficult to predict when they will stabilize or rebound, and their Q4 revenues are projected to be $800 million. This is down from the analyst estimate of $895.5 million. The next stock is PayPal, ticker PYPL. They had Q3 revenues of $6.85 billion, which is 11% increase year over year. Their total payment volume, TPV, was at $337 billion, which is a 9% increase year over year. They added 2.9 million net new active users for a total of 432 million. They expect to add 8 to 10 million net new active users in the fiscal year. They had 5.6 billion payment transactions, which is a 15% increase year over year. They have a lower Q4 forecast compared to analyst expectations due to a broader economic downturn. They do not expect much growth in the US e-commerce business during the holiday season. The next stock is the e-commerce giant Mercado Libre, ticker MELI. They had Q3 net revenues of $2.7 billion, which is a 60.6% year-over-year increase. They had a gross merchandise value of $8.6 billion, which is a 31.5% increase year-over-year. Their major markets posted solid GMV growth. Brazil had a GMV growth of 20%, Argentina 87%, and Mexico 23%. Their advertisement business continues to steadily increase. It is currently 1.3% of total GMV. This is up from 0.9%. Their fintech business continued to deliver rapid growth rates. Their total payment volume rose 54% in US dollars, and they had 40 million unique active fintech users. The next stock is coffee giant Starbucks, ticker SBUX. They had Q4 revenues of $8.41 billion, which is a 3.3% increase year over year. Their global same-store sales increased 7% year over year. In the United States, Starbucks reported same-store sales growth of 11% year over year, even though prices are up 6% from a year ago. Their loyalty program membership climbed 16% to 28.7 million people in Q4, and their daily store traffic in the US reached approximately 95% of pre-pandemic levels. This is attributed to a successful fall promotion, and their cold beverages accounted for more than 3/4 of beverage sales. The next stock is Coinbase, ticker COIN. They had Q3 revenues of $500 million, which is a 50% decrease year over year. This is compared to their expected revenue of $654 million for the quarter. Their retail transaction revenues are at $346.1 million. This is down from $1.2 billion a year earlier. This is because traders turned away from cryptocurrencies. Macroeconomic and crypto market headwinds resulted in lower transaction revenues, and their user base has declined throughout the year. In Q3, they had 8.5 million monthly transaction users. This is down from 9 million monthly transaction users in the prior period. I want to take a look at three major news articles and how they're affecting the current conditions in the world. This is felt by the markets and will continue to persist for a long time. The first one is inflation. This was on Wednesday as the Dow closes 500 points lower. Nasdaq sheds 3% as Fed Chair Powell signals intent to continue hiking rates. The Fed implemented another 0.75 percentage point rate increase Wednesday afternoon, and Powell said in a press conference that its inflation fight was far from done. We still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. Powell also added that it was premature to talk about pausing hikes. We have a ways to go, said the central bank chair. The tone of Fed Chair Jay Powell's comments was quite hawkish, which means that the Fed still has a way to go to fight inflation, and the level of interest rates will be higher than previously expected. This was said by Jack McIntyre, a portfolio manager at Brandywine Global. The second major news is, are we going to have a happy holidays? Online holiday spending is expected to be weak after months of early discounting. This year, online sales on Black Friday are expected to increase just 1% from a year ago, while Cyber Monday revenue is expected to grow 5.1%, according to Adobe. Overall, online spending throughout the holiday season is forecasted to grow 2.5%. This is the smallest growth since Adobe started tracking the figure in 2015. Adobe even warned of a potential decline, projecting a range for sales to be between down 2% and up 5%. The pullback in spending is likely to carry over into the holidays. A survey from KPMG found that 85% of holiday shoppers are concerned about inflation and that 34% will opt for cheaper gift categories. And the final major news is related to housing. Pending home sales fell 10% in September, much worse than expected. Pending home sales, a measure of signed contracts on existing homes, dropped as much as worse than expected 10.2% in September from August, according to the National Association of Realtors. Economists had predicted a 4% decline. Sales were down 31% year over year. Realtors point squarely to sharply higher mortgage rates, which had sat at record lows for the first 2 years of the pandemic. The average rate on the popular 30-year fixed mortgage was right around 3% at the start of this year, but then rose swiftly, crossing 6% in June, according to the Mortgage News Daily. It pulled back a bit in July and August, but then began rising again, crossing 7% in September when these contracts were signed. Overall, things are going to be rocky, which is why I'm dollar cost averaging. I do believe there's a lot of opportunities right now, but I'm not investing all at once. I'm investing in small amounts here and there. I am keeping an eye on the housing market, especially the mortgage rates. Rising mortgage rates coupled with inflation, that combination is not good for the economy. Let me know what you think in the comments below. If you enjoyed this video, please give me a thumbs up and subscribe. As always, thank you for tuning in, stay safe, and I'll see you all next time.